Hello everyone, my name is Muhammad Hasham bin Muhammad Himdanan and I will explain about the background of Zulian Corporation Berhad and Huatai Industries Berhad. Zulian Corporation Berhad is one of those companies that have been established in 1989 and is still standing strong until this day. This company have their own vision, which is their trusted partner in the success journey of collaboration with the people in help each other thrive towards a better living while cultivating the culture of embracing beauty and health among communities. The mission of this company is that they exist to provide a business model and high quality, value for money product that empower entrepreneurial success as well as helping the community the company serve. Huatai Industry Berhad was established in 1986. Huatai Industries Berhad was established in 1962 and has since grown to become one of the largest biscuit manufacturers in Malaysia. The company was listed on the Stock Exchange Malaysia in 1921. Through the years, Huatai has increased its product line and extended its reach to more markets, exporting about 40% of its production to more than 50 countries. Huatai is known for quality halal biscuits sold under the brand name Huatai and Luxury. It is a well-known company in Malaysia, traceable from small shop to big store, fast food restaurant and airlines. They work hard to constantly improve and maintain quality to meet the best standard.
Good day everyone, my name is Raghupati. My matrix number is 302002. For liquidity ratios, current ratios formula are current assets divided by current liabilities. For Zulian Corporation Berhad, the current ratio is 5.73. Zulian Corporation Berhad has a very high current ratio, indicating that excellent liquidity and a strong ability to cover short-term obligations. And for Huatai current ratio is 0.97 and Huatai current ratio is below 1, meaning its current liabilities exceeds current assets, raising concerns about short-term liquidity. For quick ratio in liquidity ratio, the formula of quick ratio is quick assets divided by current liabilities, which is Zulian Corporation Berhad has 4.80 quick ratio. Zulian's quick ratio confirms strong liquidity without relying on inventory. On the other hand, Huatai quick ratio is 0.57 and which is significantly lower than 1, indicating liquidity challenges even after excluding inventory.
Hi, my name is Lim Sengda and my matrix number is 306076. From this slide, you can see total asset turnover ratio for two companies. The formula for calculate total asset turnover ratio is net sale divide average total assets. The total asset turnover ratio for Julian is 25.14. This ratio means that Julian generate 25 ringgit 40 cents in revenue for every 1 ringgit asset its own. For the second company, Huatai total asset turnover ratio is 0.95. This ratio means that Huatai only generate 95 cents in revenue for every 1 ringgit of its assets owned. From this slide, it shows account receivable turnover ratio for two companies. The formula for calculate account receivable turnover ratio is net sales divide average trade receivable. Account receivable turnover ratio for the first company, Julian, is 0.55. This ratio means Julian only collects its account receivable approximately 0.55 times a year or less than once a year. For the second company, Huatai account receivable turnover ratio is 2.62. This ratio means Huatai collects its account receivable approximately 2.62 times a year.
For profitability ratio, net profit margins formula is net profit divided by revenue times 100, which is Julian Corporation Berhad net profit margin is 22.08%. Julian's high profit margin indicates excellent profitability and cost management. On the other hand, for Huatai's net profit margin is negative 8.80%, which is Huatai negative profit margin reflects operating losses and poor profitability. In profitability ratio, the formula of return on equity is net income minus preferred dividends divided by average common shareholders' equity, which is Julian Corporation Berhad has 6.33% on return on equity, and Julian's moderate return on equity indicates reasonable returns for shareholders. On the other hand, for Huatai's return on equity is 102.34%, which is Huatai's negative return on equity indicates severe losses for shareholders.
Hi everyone, my name is Lim Sengda. My matrix number is 306076. Today I'm going to present about leverage ratio. Leverage ratio measures the extent to which a company uses debt or other financial obligation to fund its operations and growth. They are important for evaluating the financial health of a business, its risk level, and how well it can handle its debt. There are two parts in leverage ratio. The first one is debt to assets ratio. Debt to asset ratio is a leverage ratio that shows the proportion of a company assets that are financed by debt. It helps assess the level of risk a company has taken on in terms of its debt obligation relative to its total assets. The formula for debt to assets ratio is total liabilities divide total assets. From the slides, you can see that Julian's debt to assets ratio is only 8.20%. This percentage shows that only a small portion of its assets is financed through debt. This percentage highlighting Julian have strong financial stability. The company mainly relies on equity and internal funds, minimizing exposure to risks like interest rate change or repayment obligation. This low reliance on debt ensures lower financial risk. However, while this conservative approach reduces risk, it may also limit Julian's ability to pursue aggressive expansion, potentially restricting its growth opportunity. For the second company, Huatai debt to asset ratio is 72.45%. This percentage shows that the most of the assets of Huatai are financed through debts. This percentage will lead a high financial risk to the company. The company is heavily reliant on borrower funds, making it vulnerable to economic downturns and rising interest rates. This also creates potential liquidity issue as Huatai may face challenges in meeting debt obligation if revenue or cash flow is inconsistent. On the positive side, the high debt could indicate investment in expansion or business growth, which might bring higher return if successful. However, this strategy carry significant risk if those investments do not pay off. For the next part, debt to equity ratio. Debt to equity ratio is a leverage ratio that compares companies' total debts to its total equity. For the formula of debt to equity ratio is total debts divided total shareholder equity. From this slide, you can see Julian's debt to equity ratio equal to 0.089. This reflects its low financial leverage and conservative capital structure. The company relies on equity more than debt. This can ensure lower financial risk. However, while the low debts reduce the risk, this also shows that Julian is not aggressive leveraging debts to fund expansions. This will potentially limiting its growth opportunities. For the second company, Huatai debt to equity ratio is 2.63. This shows that high financial leverage with the company have more than double the debts compared to equity. This heavy reliance on debt financing will come with higher financial risk, making the company more vulnerable to the cash flow issue and rising the interest rate. Huatai aggressive strategy suggests that it may use the debt for investment and it will bring higher returns if successful. However, this approach also increases the risk of financial instability if the investment do not perform as expected.
Good day everyone, now let's dive into the financial ratio comparison of Julian Corporation Berhad and Huatai Industries Berhad, which is focusing on liquidity and equity, profitability and leverage. This analysis will not only reveal the strengths and weaknesses of each company, but also highlight areas of improvement. And I'm Harvey Raj and my matrix number is 301730. We start with the liquidity ratios, which is the current ratio measures a company's ability to pay off short-term liabilities using its current assets. For an example, Zulian Company. The calculation is straightforward. We take its current assets and divide by its current liabilities of this company, and this gives us a current ratio of 5.73. What this means is that Zulian can comfortably cover its current liabilities nearly 6 times over, demonstrating a very strong liquidity position. Now let's look at Huatai. Its current assets stand at something 53,000 above, and its current liabilities are 54,000 above. Dividing this gives a current ratio of 0.97, which is less than 1. This indicates that Huatai does not have sufficient current assets to cover its short-term liabilities, pointing to potential liquidity issues. Next, the quick ratio, which includes inventory to focus on the most liquid assets, provides more insight. For example, Zulian Company, subtracting its inventory of 34,854,000 from its current assets gives 179,598,000 divided by its current liabilities results in a quick ratio of 4.80. This shows that Zulian is well positioned to meet its liabilities even without relying on inventory. On the other hand, Huatai has a quick ratio of 0.76 after subtracting its inventory. This means Huatai is heavily relying on inventory to settle its liabilities, which may not always be ideal. Clearly, Zulian has a much stronger liquidity position compared to Huatai Company. Hi, Zulian Corporation Berhad and Huatai Industries Berhad are compared based on activity ratios. For total asset turnover, Zulian generates 26 cents in revenue for every 1 unit of assets, showing moderate efficiency while Huatai achieves a higher turnover, 1 unit 5 cents, reflecting efficient asset utilization. For accounts receivable turnover, Zulian collects receivable 5 ringgit 54 times annually, indicating strong credit control, and Huatai slightly outperforms with 5.85 times, showing efficient receivable management. So moving on the profitability ratios, Zulian's company's less profit margin is 22.08%, meaning it retains 22.8 in profit for every 100 of revenue after covering expenses. In contrast, Huatai company has a negative margin of negative 10.33%, which reflects significant losses and operational inefficiencies. The return of equity (ROE) also highlights the stark difference in performance. For Zulian's company, ROE is 6.33%, indicating moderate returns for its shareholders, while Huatai's company ROE is a staggering negative 82.12%, showing that it's not only unprofitable but also eroding shareholder value. These figures emphasize Zulian's company's superior cost management and profitability compared to Huatai's struggles to operate effectively.
For the comparison of these two companies, Julian and Huatai have very different financial strategy. Julian have low leverage ratio. This shows that Julian's mainly relies on equity and internal funds. This will ensure that Julian have high financial stability and lower risk. This makes Julian's a good choice for investors that seeking for low risk and dependable returns. In contrast, Huatai have high leverage ratio. This shows that Huatai are heavily relies on debt financing. This strategy suggests the company focus on growth and expansion, but come with higher financial risk, such as cash flow change. Higher risk mean higher returns. This makes Huatai become good choice for investors that comfortable with financial uncertainty. In summary, Julian is a stable, low-risk option for long-term investor, while Huatai offer high-risk, high-reward opportunity. For the comparison of these two companies, Julian's debt to equity ratio is 0.089 or 8.9%. This highlights that Julian's are more rely on equity to finance its operation. This result enhance financial stability and low risk, as the company minimal debt reduce exposure to rising interest rates or economy downturn. Julian is the choice for investors that looking for stable and low risk and for long-term investment. In contrast, Huatai debt to equity ratio is 2.63 or 263%. This reflects that Huatai is highly reliant on debt. This aggressive financing strategy may be aimed for fueling expansion and business growth, but it comes with high financial risk. The company may face more challenges like cash flow change, interest rate increase, and market fluctuation.
My name is Myeong and my mention number is 303042. Let's start with Julian company. Julian has a remarkably low debt to assets ratio of 8.2% and debt to equity ratio of only 8.9%. This prudent financial management gives Julian stability and resilience during economic downturns or proud of raising interest rates. However, its reliance on equity financing limit its ability to pursue aggressive growth stages. To unlock further potential, I propose the following action. For one apart is depend product range by introducing natural skincare products and healthy snake. Julian can attack a broader customer base and boost sales. And two is enter global market. International expansion, particularly in emerging economies, can open new revenue stream. Cooperating with local business in this market would enhance the effectiveness of this strategy. The three is motivate employees, providing better training and intensity with drive innovation and foster teamwork, enhancing our productive. And the fourth is focus on digital sales. Students should be captive on this exciting economic platform by leveraging digital tools to improve customer engagement and drive online sales. Let's start with the Huatai company. Huatai operates with significantly higher debate to assist ratio of 72.545% and debate to equality ratio of 2.63. This relies on debate present opportunities for growth, but also explores the company to substantial financial risks, especially during economic downturns or when interest rates rise. Despite these changes, Huatai exports 40% of its products, demonstrating strong international reach. To strengthen its position, I recommend the following. One of the suggestions is produce debate levels. Huatai should consider alternative financing methods, such as insuring shell or attracting these investors to level its debate driven and mitigate financial risk. The two is introduce healthier product. Launching low sugar or gluten-free biscuit would cater to the growing segment of scale conscious customers and the diversity the product overseas. And the third one suggestion is third, the third suggestion is build a stronger brand, leveraging social media and protecting in international trade event can enhance Huatai's brand visibility and global presence. In conclusion, while Zulian focus on stability and innovation, Huatai can capitalize on growth opportunities by managing its financial risks more effectively. Both companies had the potential to thrive in their respective market by implementing and these target structures. Thank you for your time, and I look forward to discussing this recommendation further. Thank you.